these sessions just in case. So the incremental analysis. Can you guys see my screen?
Yeah.
Yes, Professor.
Awesome. On the incremental analysis, we're just comparing alternatives and getting the difference between one alternative and another alternative, and seeing the effect that that alternative is going to have on us. We have to take into consideration for different purposes, different costs, but for the decision making, first we're going to focus on the relevant cost, the cost and revenue, which are different between one alternative and another alternative, and the cost and revenue that's going to happen in the future. Those are the ones which are relevant for us. The other relevant cost is the opportunity cost. Opportunity cost is always the cost that we give up taking one opportunity versus another opportunity. The interesting thing with the opportunity cost is you don't have to pay it. That's one of the costs that you don't have to pay it, but you have to consider it in your decision. The one cost that you never have to consider, that's a sunk cost, which is cost that already happened. That cost cannot be changed, cannot be avoided. So for that reason, that cost never going to be considered. Let's see what we did here, and let's go over quickly. First thing that we did in class was to accept special order or not. So again, this is a special order, one-time order and one-time only. The sales of the company is not going to be affected. The other customers not going to know about this special order. They're not going to start complaining, hey, reduce our price, selling price as well. So nothing's going to be affected by this special order. The decision criteria here is we're going to take the special order only and only if the special order increase overall net income. Again, we're taking the special order only and only if that special order increase our net income. Now, for the purpose of this course, and only for the purpose of this course, not for the purpose of the practice, we will assume that company operates within the relevant range when there's a special order. Means that we're making the existing fixed cost is not relevant. For that reason, we're not going to consider the fixed cost when we making decision for the special order. Fixed cost is going to be ignored. And we went through this question when the customer offers to buy a special order of 2,000 blenders as $11, out $11. There will be no effect on the normal sales. The operating capacity as 80%. Current fixed manufacturing cost is 400 or $4 per unit, which we said in this case the current fixed manufacturing cost, that is irrelevant for our decision. So we're not going to consider this one. We're going to focus on the variable cost. For that reason, once we do the calculation, we base our calculation only and only on the variable cost, which variable cost at 2,000 units is 16,000, and sales price on 2,000 units by $11 is 22,000. That's why here is if we reject the order, if we reject this offer, special offer, we're not going to get anything. But if we accept it, we're going to get $22,000 revenue, which is 2,000 units times $11. Sales price per unit here, $11. And the cost will be the only and only the variable cost, which is $8 per unit. Times 2,000 units, 16,000. So That's going to increase our income with $6,000. And since our income increase, accept the order. Remember, for the special orders, as long as the revenue covers the variable cost, go for it. We did this question here. What will be the increase? Again, stay with the variable cost, calculate the variable cost only, see the effect by the number of units, and you're going to come to the answer. The next decision that we did in the class was make versus buy. Should I outsource it, or should I produce it at my premises? Now the decision criteria here is we always will outsource if the total cost saving is positive, means that the price that we have to pay is less than the total cost saving. That's for the quantitative analysis. After that, we have to perform this qualitative analysis. That's something that you might have to do on your, when it comes to the last case submission, you have to provide the qualitative analysis as well. For make versus buy, you have to consider the quality, the environment, any impact on the community by laying off employee if we decide to outsource it. Advantages, which advantages? From here, from the slides, you can see the advantages of the buying versus making. Here, I'm going to put a bracket. I'm going to go a little bit away from the cases, from the individual cases that you have submitted. I saw a few of you using citation, quotation, outsource materials. In those simple cases, where we discuss everything in class, when you have all the information available in the case and in the slides and in your study materials, you don't need to use outsource resources. When you're using the outsourced resources, the only thing that shows is that you don't read the slides, or you don't read the posted materials that you have on the Brightspace. You have enough material in the Brightspace. You don't need to go outside and do researches or go with some theories or some people, quotation, citation. You don't need to do that. That's extra work. If I were you, I wouldn't do that. So, again, the decision criteria here, let's go back to our make versus buy decision criteria. As long as the saving is more than the cost of purchasing, we're outsourcing it. In our case here, applying the information that we have, the relevant information was the direct material, direct labor, variable manufacturing overhead cost. We have additional information here that says that if we decide to purchase, we can eliminate all of the variable costs, so those 40,000 are going to disappear, and only 10,000 of the fixed cost. So those 60,000, it's not going to be 60 anymore, it's going to be only 50. Means the 50,000 will remain. So if that happens, as if we make it, it costs us $225,000. Now, if we buy it, we have to pay 200,000 plus we still have to pay for the 50,000 of the fixed cost, which is still with the company. So it's going to cost, if we decide to buy it, it's going to cost us $250,000. For that reason, we're not buying it. We still keep making it. Now, if we have to consider the opportunity cost, which means that if we decide to buy it, that will free our resources. We're going to have space, we're going to have labor resources. And if we manage somehow to generate additional income from the resources that we free, if we generate $38,000, the $38,000 will going to be enough to cover the $25,000 difference, unfavorable difference in situation when we buy. And furthermore, it's going to generate income from us for $13,000. So if we decide to buy it and outsource, then we can generate $13,000. That was that question, that was that thing. Now the sales or process further. Sales the process or process further is when we're producing one product and we decide at some point to split it on different products or process it further to something additional rather than selling it as it is. Decision criteria here is we're going to process further only and only if the incremental revenue is more than the incremental processing cost after the split off point. So there are two decision scenarios. Again, a single product. We can sell the product as it is, or we can process it further to make something else and then sell it. Multiple product, we're producing one single product. And from that one single product, we're going to split it in the different products, which are called as a joint product. The first scenario was this company manufacture tables, which have two options: to be unfinished table or do some extra work and finish the table. If we sell it as an unfinished table, we sell it for $50. If we finish it, we can sell it for $60. So the additional sales revenue that we can generate per table is $10. Now the question comes is, how much is going to cost us to move that table from unfinished into the finish? Let's see what the case says. So the relevant per unit cost of finishing table is direct material is going to increase with $2, direct labor is going to increase with $4, and manufacturing overhead is going to increase with $2.40. As long as the additional cost is less than additional revenue generating per single unit, go for it. So in this case, our additional revenue is $10, 60 versus 50. If we finish it, it's going to cost us $8.40 to finish it. So that means we generate $1.60 per table if we go for the finish. Take it. $1.60, just take it. So again, if we have to do this calculation, show it in Excel spreadsheet, it's going to be additional increase in the revenue will be $10. Direct material is going to jump with $2, direct labor $4, variable manufacturing overhead $2.40. In all total, $8.40. Additional profit that we generate and $1.60 per table. For the multiple products, if we have to decide, we're going to have this, those called joint products, and products who, if once we can identify the products at the point that we can identify product as a single product, then that's going to be a split of point. Means that the cost prior to that split of point is irrelevant. So for our decision, we're only going to look for cost after the split of point and additional revenue, incremental revenue that we're going to generate after the split of point. So where was our question here? Question was, I'm selling it currently. I'm selling the cream at for $19,000. I can process it further and make from the cream cottage cheese. And then I can sell the cottage cheese for $27,000. If I do that, I'm going to generate $8,000 increase in my sales. However, to process it from the cream into the cottage cheese is going to cost me $10,000. Should I go for it? No. Why? Because I'm going to lose $2,000. That additional sales, change in the sales price from 90 to 27 is not enough to cover my cost for the processing from the cream into the cottage cheese. However, if I have sell the skim milk, I can sell it for $11,000. But if I process it into the condensed milk, I can sell it to $26,000. That's going to give me increase of $15,000. My additional cost for the processing will be $8,000. Since the sales increase is more than the cost increase, additional cost that they have to pay, in that case, yes, go for it. There's increase in income, go for it and process it. Process that skim milk into the condensed milk. So tell me what you think about this question. I'm not sure if we covered this in class. I think we're coming to the point that we didn't cover those things in the class. What do you think about this? Any other suggestions?
Incremental process cost.
Sorry?
Incremental revenue is more than
A?
A.
The
Looks like
answer
it.
is incremental process cost.
Should be A, yes. And you're correct, yes. Incremental processing cost is the one that we have to consider in this. How about the next question?
D.
And now I think we did this one in class, right? Cost of the labor per hour is not qualitative factor. Yes. Did we did this in class?
Yes. Yes, we did.
We did.
Yes, Professor.
Do you understand how we get the answers? Everybody understand how we get the answer?
We can still do
no,
it.
sir. No.
No, Professor, we can still do it.
We can still do it.
Yes.
Okay. Let's do it then. For that reason, we're gonna use the help from Excel. You can see my Excel spreadsheet, right?
Yeah.
Sure.
And now we can see the question, right?
Yeah.
Awesome. Okay, let's see. Okay. Now, from this question, what we can see? We can see that the joint process cost is $80,000. We already said the joint cost is irrelevant. The other thing that we can see, we're dealing with the 5,000 kilograms, correct? That's the quantity that we're using, 5,000 kilograms. Now, one option is, so I can sell it at the split point for $20 per kilogram, correct? Or process further as it is, or process. If I process further, I can sell it for 25, correct?
Yes, Professor.
10,000 kilograms of beta can be sold at the split of point of $15 and processed further at additional cost of 20,000 and sold $16 per kilogram. If venture decide to process alpha beyond the split of point, income will be, now we have to calculate what will be the income. Now, can we get our total sales first? We know the sales per unit, correct?
Yes, Professor.
Can I get my total sales?
Yes, we can.
That was for alpha, right? No, yeah, that's for alpha. And the total sales will be equal to 5,000 times 20.
20,000.
So that will be the, let's make it like $100,000. Here we're gonna get 5,000 times $25. So how much will be the additional that we're gonna get?
25,000.
Increase will be, or additional, will be this one minus that one. That's on the sales, right? How about the cost? They're saying the cost, additional cost, or let's say additional. So now we know how much will be additional increase in sales, right? So let's say how much will be additional cost. Additional cost will be negative 20,000, correct?
Yes, Professor.
So should I process further? What's the net change?
Increase of 5,000.
Net change in this case is increase,
Yes, Professor.
5,000.
5,000. So should I go for it?
Yeah. Additional.
Am I making? Is my income going to increase? Obviously, $5,000 going to increase, correct?
Yes. Yes. Yes.
So let's see what's going to happen. Let's do the beta too. Let's do this for beta. Let's see how the beta do it. On the beta, how many kilograms we have? 10,000. Correct?
Yes, Professor.
But on the beta, we can sell it as it is at $15, or we can process it further at $16, correct?
Yes, Professor.
So we're gonna get additional $10,000, but it's gonna cost us $20,000.
Okay.
Shall we go with this?
No, Professor.
Why? Because
The cost of processing is higher than the
yes,
profit.
it's more than additional sales or additional income that we're gonna generate.
Yes, Professor.
In this case, with additional revenue, not income. Okay, great. Let's go back to slides. And the answer is $5,000. And as you can see here on the sales price is 100,000. If we process further, we're gonna sell it for 125, which is gonna give us additional $25,000 minus the 20 incremental cost. That should be actually, that should be here. That should be like this. So if we sell it as it is $100, if we process it further, it will be 125 minus the $20, 105, $5,000 increase. So the question here will be retain or replace equipment. Decision criteria. We're going to replace the asset if the new asset increases the net income. For that reason, at the time value of the money, capital cost allowance, its income tax also will be eliminated. So what we have to do? We have to check the book value, which is book value is a sunk cost. So for that reason, that's not relevant. So we're going to ignore this. Salvage value is the one thing that we're going to get if we sell the old equipment. So that's something that we have to consider. Useful life, how long the company can expect to generate revenue from the asset is another thing that we have to keep in mind. So the question here was this company is considering replacing the one of their new machine with the new one of the machine with the newer machine. If the new machine is purchased, now there will be reduction in the manufacturing cost from 160 to 125 per year. Other information, including the book value of the old machine, is $40,000, which we said this one is irrelevant, so we can easily ignore it. Cost of the new machine, however, is relevant. Remaining useful life of the old machine and the new machine is exactly the same. Salvage value of the old machine is that will be relevant cost. So let's see what's going to happen. If we keep using the old machine, our cost will be $640,000. But if we purchase the new machine, we're going to reduce the cost with $140,000. Why 140? Should be 160. From 100 per year. Oh, from 160 to 125. Do you understand this logic? Can you see the numbers?
Yeah.
So, how they come up with 640? 160 times 4. Total cost for the period will be $640,000. 125 times 4 years, if we get a new machine, the new cost will be $500,000. Plus, we have to pay for the new machine. That is going to be total of $620,000. But we can sell the old machine, which is going to reduce the cost of the new equipment to $650,000. For that reason, we can save $25,000. So, shall we go for it?
Yes,
Yeah.
Prof.
Absolutely.
Yes, Professor.
Definitely.
Now, what is the salvage value for the old equipment? considered to be?
Relevant cost.
A relevant cost. Now we have to see which is the eliminate the unprofitable product or segment. So management, you as a manager one day, you have to decide, should I discontinue any of the product or product line, segment or division or customer? Decision criteria is, you're gonna drop them if you improve overall income. So if you see increase in the income, eliminate the client or eliminate the product or eliminate the division. Key here will be how appropriate we allocating the cost. For that reason, we have to understand that there will be avoidable fixed cost and unavoidable fixed cost. Avoidable fixed cost is if we eliminate the client, that cost will be gone. Unavoidable fixed cost is that if we eliminate the client, that cost will still gonna be happening. For example, if I'm running the coffee shop, if I'm running my coffee shop, and I decide that I'm not gonna sell any more latte. If I stop selling the latte and eliminate it as a product, how this gonna reduce the cost of the lights in my store? Can I save by, if I eliminate the latte from my products in my coffee store, can I save on the lights?
No.
No. So should I, if comes to the lights, should I consider lights as a part of the cost of my latte?
Yes.
So again, if I eliminate the latte, can I save on lights?
No, light is the
I-
fixed cost.
Life is the unavoidable fixed cost,
Yes.
right? So if I have to make a decision about the latte, should I stop or should I continue? Should I include the lights in the cost? What do you think, yes or no?
I think the
Sorry,
light
sir,
is part of the manufacturing overhead. So
It
it
is
should-
part, no questions about it, part of the non-manufacturing cost. But again, if
No.
yes, the answer will be no. But let's I want you to come up with this answer and everybody to understand this one. If I cannot, if the cost that I'm considering, like a lights, it doesn't affect the cost, the overall cost. If I eliminate the latte, I'm not gonna include it in the cost of the latte. Make sense? Because if I discontinue to produce latte or to serve or to offer latte to my clients because of the cost of the light, by cutting the latte, I'm not going to reduce the cost of the light. Make sense?
Yeah, sure, yeah.
So for that reason, that is unavoidable fixed cost, which has to be eliminated on the cost calculation when I'm making decision, should I keep latte or not? Make sense? Do you understand this logic or not? Should I explain it in different way?
Yes, please explain in different way.
In different way? Okay,
Yeah.
so you have two divisions. You have a restaurant and you have a bar. Okay? And you have accountant for which you're paying $60,000 to do the accounting for your company, which including the restaurant and including the bar. You're allocating the cost of the accountant, $60,000, to the restaurant and to the bar. If I eliminate the bar, can I get rid of the accountant?
No.
No, I still have to pay him $60,000. Make sense?
Yeah. Yeah.
So for that reason, should I eliminate the bar because of the accountant?
No.
No.
Is the cost of the accountant avoidable or unavoidable fixed cost?
Unavoidable.
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 Unavoidable. Make sense?
Yeah.
Yeah.
Do you understand now? Now the
Yes,
same thing
sir.
with the light. You have a light. So am I gonna offer regular coffee or latte or cappuccino? It doesn't matter. If I cut the cappuccino and decide no more cappuccino in my coffee store, I cannot reduce the light, cost of the light. So for that reason, when it comes to the decision, should I eliminate the cappuccino or not, the cost of the light is irrelevant because it's unavoidable cost. And that's going to continue happen regardless if I producing cappuccino or not producing cappuccino. Same thing with the bar. The cost of the accountant still going to be there. I still have to pay him $60,000 regardless if I have the bar or not. Make sense? So let's go with this now. Consider the effect on a related product line or segment. First thing that we have to do, fixed cost allocated to the unprofitable line must be absorbed by those on the other one. Net income may decrease when unprofitable product line or segment is eliminated. So if we allocating the fixed cost to unprofitable line or segment, which later can be absorbed from the rest of the company, then the net income might decrease. So the decision criteria here is we're going to keep the product or segment or the division unless the saved or eliminated fixed costs are more than the loss contribution margin. So let's see how we're going to apply this. So we have three divisions: Pro, Master, Champ. Total, we're making total sales $1,200,000. Variable cost that much. Contribution margin from the all three product total is 380. Now, let's see contribution margin per product. These guys, first one, Pro, generate $280,000. Next guy's Master, they're generating $90,000. Champ, only $10,000. Fixed cost allocated to all the products, $80,000 for these guys, $50,000 to Masters, and $30,000 to the Champ. That makes the Champ unprofitable. Now, actual fixed cost will not change if unprofitable line is dropped. So what that means? If we drop the Champ, we still have to pay $160,000 fixed cost. The question is, shall I drop the Champ?
If the champ is unprofitable, we have to drop it.
Yes, it is unprofitable. Okay, so
But it's sharing with it's sharing the fixed cost. So it means that we have actually dropped in profitability if we drop it.
that is also correct. So what should I do? Drop it or not drop it?
Keep it.
Keep it.
If it's not profitable, we have to drop it.
So, but some people say if it's not profitable, you have to drop it.
It's unprofitable, but it helps
It
out with the
doesn't,
fixed cost.
it doesn't affect the 160.
So let's, before we decide what to do, let's put this data here, right? It's not going to take me too long. Cells, I have the variable cost. Can you see my screen? Contribution margin, fixed cost, and net income, correct?
Yes, Professor.
So let's see what's going to happen here. We have Pro, we have Master, and we have Champ. And we have Total. Here I have 800,000. Here I have 300. And here I have 100. Then I have here 520. Then I have 210 and 90,000. Then I have the fixed cost, which is 80,000 here, 50,000 here. That's 5,050 and 30,000. Right? Let's make it with all this one to be more presentable. Those are the numbers that they have, correct? I wish I had these different numbers, but that's what I have. This is what I have to work with. So my totals are easily to get. That will be my total here. 1,020,000, and I can drop down and see what's this. Contribution margin, that will be equal to this minus that one. And I can easily drag it and get what is it. So pretty much I'm getting the same thing, right? And my net income will be the contribution margin minus the fixed cost. This is where I am, correct?
Yeah.
Yes,
Now,
Professor.
right. But here the question says, the actual fixed cost will not change if the unprofitable line is dropped. Which one is unprofitable?
Champ.
Champ is unprofitable. Which is the actual fixed cost? 160, correct?
Yes.
So, if I drop the champ, what's going to happen? This one's gone,
Yes.
gone. But this one's going to stay 160.
Mm-hmm.
So, that calculation now is not correct. So this one going to be equal to this one minus that one. Where is my profit now?
It has decreased to
Has
two.
decreased.
Yes.
So should I drop the champ?
No.
No. Why? Because I'm going to lose how much?
$10,000.
Which
Yeah,
$10,000 is what?
The contribution margin.
From the champ.
the loss contribution margin.
Make sense? So now,
Yeah.
what was says in the question? The question says, the slide says, if you're dropping it only and only if the contribution margin lost is less than the fixed cost saved. Make sense?
Yeah.
If you're saving more on the fixed cost than the contribution margin loss, drop it.
Okay.
Are we saving here on the fixed cost? If I drop champ, am I saving on the fixed cost?
No.
No.
So, but I'm losing $10,000.
Yes.
right?
Mm.
Make sense? So for that reason, we keep it. We're not gonna get rid of it because we are better. We're making income if we have it rather than if we don't have it.
Okay, Professor. So let's say, for example, the contribution margin is 5,000.
Even if it's 5,000, let's go with the 5,000. Let's go with the 5,000. That will be 95, right? Now my contribution margin 5,000. Correct?
Yes.
So let's say we drop it. So we are here on, this is one scenario, right? Let's get the same scenario here. So I'm dropping it, but my fixed cost stay 160.
Okay.
Should I drop it?
No.
No. How much I'm gonna lose? The 5,000 contribution margin. Gone. Make
So
sense?
if the profitability does not contribute to the profit of the whole company, if
No,
the
no, no.
contribution
Listen this. Listen this. You guys go in different direction now. If now here says the fixed cost will not change, but if my fixed cost by eliminating this jump drop with $10,000, that 160 become 150. Should I go for it?
No.
no, no.
What? Watch this. Look where I am. With jump, my profit net income is 250. Can you see it?
Yes.
If I
Yeah.
drop them, right? If I drop the jump and my fixed cost drop down with $10,000, where's my
Okay.
income now?
220, then we should drop them.
I should drop them. Why? Because how much my fixed cost drop down?
It ha
2,000.
by
This
10.
one minus that one, right? No,
Mhm.
my fixed cost drop down with 10.
10,000. Yes.
How much my contribution margin drop down?
5.
5.
Mm-hmm.
Am I saving?
Contribution.
Actually, it should be the opposite. I'm losing the contribution margin, right?
Mhm.
That one is I'm losing, but on the fixed cost, I'm actually
Gaining.
saving,
Yes.
right? So where am I? More saving or more losing?
More saving.
More saving.
What?
Then go for it.
Okay, Professor.
Make sense?
Yes, Professor.
All right. At least this one is clear. So let's see the other scenario so you can compare it apple to apple. I think that's more powerful when you say it side by side, right?
Yeah.
So in this case that we have, what happening here? If we go directly with our question. So now our variable cost here is at 90,000. I'm losing 20,000, correct? But if I go in this case, if none of my fixed costs changing, so this should be 160, correct?
Yes.
So where am
Yeah.
I?
You're
I'm
losing.
I'm losing 10,000 on the contribution margin, but
Yes.
I'm not saving anything on the fixed cost.
Yes.
So who is the big loser here?
I am.
I
I
am.
am.
No, we're not, because now we know what to do, right? When you see something like this, now you know what to do. You're not gonna be snowed by the fact that this division is negative. It doesn't matter. Tell me how much you can save on the fixed cost.
Okay.
See how much they're making as a contribution margin. See if they save on the fixed cost. How much minimum I have to save on the fixed cost in order to eliminate this division?
10,000.
But if it's 10,000, watch this. If this one becomes 150, I'm zero. In this case, should I eliminate the division?
Yes,
Why?
I will have to consider effort, time.
Okay, one thing. Okay, give me 3 reasons why should I eliminate the division, and give me three reasons why I shouldn't eliminate the division.
Okay. So as I've said, to eliminate it, I'll consider the effort to put it together and the time.
Okay,
for
okay.
me
So
to eliminate it,
one. Give me 2 more to eliminate it.
I can't
If
think of
there is an opportunity for
Variable
more
cost,
profitable,
Okay, that's 2. Third one.
affect the
tying up
variable cost.
money. It's tying up money
Oh.
for
Okay, I can buy it. Now,
yeah.
give me 3 reasons why I shouldn't eliminate it.
Because we might have change in sales, and then that particular session might pick up and start making profit.
Okay. Number 2.
if there are no alternatives to generate another income.
Okay. Number 3.
Fixed costs, because it's going to.
Think about something else. I want you to think about
Okay.
my employee.
Oh, that's true.
Variable cost.
My employee. Right
Okay.
now, I'm not making money, but I'm not losing money, right?
Yes.
But am I keeping my employee busy?
So that's another.
Make sense?
Yes, Professor.
Yeah.
So if I eliminate it, they're gonna start checking their cell phones, start texting, start checking their personal emails. Do I want that? I want to keep them
No.
busy, right?
Yes.
So that's why sometimes it's good for you to work on the break even or the same profit, but with another division rather than eliminate it. And again, as a number 2, you don't know, it might become profitable, right? Okay, good. I want you to understand that everything that has a positive has a negative. So the same scenario, you can sell it as a positive or you can sell it as a negative. Depends what you want. Make sense? Remember this.
Yeah.
Okay, let's go with the next one. Slides, where are the slides here? Here we go, I found the slides. So here, what we decide? Shall we drop it or should I not? If the fixed costs remain the same, not dropping it, keep it. Why? Because if I drop it, I'm gonna lose $10,000. Make sense?
Yes, Professor.
So the other way you can do it is this way. If I continue, this is what's gonna happen. Right now, looks like I'm losing 20,000. But if I eliminate it,
You're
my
losing.
contribution margin is loss, will be 0, but my fixed cost is gonna stay the same. Make
Yeah.
sense?
Yes,
So
Professor.
I'm losing the contribution margin. I'm not saving anything on the fixed cost, so I'm the loser here. Do not eliminate it. Tell me what you think about this one.
B.
I would agree with that. It is B. So let's do this together. So this company manufactures sells the two items A and B. The company is considering dropping the product B. It's expected that the sales product ads will be increased by 30 as a result. If the product B is dropped, the fixed cost of 2,000 will be avoided. Income statement of both products follows, right? You want to do it together or you want to do it by yourself?
Together, Professor.
Okay, let's get something working here. Just give me a second to prepare the scene for what's coming. Almost done. Give me a few more seconds. And now I can share my screen with you. Here we go. That's what we have here. This company manufactured those products. Put it this way. This is the question is, what shall we do? Manufacture product A and product B. The company considered the dropping product B. So we eliminate this one. So let's make this calculations here. It is expected the sales of product A is going to increase by 30% as a result. If the product B is dropped, fixed cost of 2,000 will be avoided. Income statement of both products is as follows. So what we're doing, we're dropping this one, correct? Let's see if that's the formula. No. Let me move the formulas this way. Can you guys see my screen?
Yes, Professor.
Yes, Professor.
This is what we get. Correct? So if I eliminate this and the fixed cost, how much is the fixed cost? 6,000, right?
Yes.
Yeah.
They're gonna become 4,000,
Yes,
correct?
Professor.
4,000,
Yes.
right? That's where we are on the fixed cost. Now, what's gonna happen with the sales?
For A to increase by 30%.
30%. So what's that increase in 30% in sales?
13,000.
80,000.
So let's see, 13,000. Let's see the increase. Let's increment here the increase. This one will be
Okay.
equal to this one time 0.3, right?
Yes.
Sales increase. What's happened with the direct material?
Nothing.
Why nothing?
No, 70%.
I can't.
Okay.
What's going to happen
Yeah.
with the direct material, people? Are they going to increase too?
Yeah, they're going to increase by 30%.
With 30%. Don't forget that.
They're
Make
going to
sense?
increase by 30%. Yes.
Do you understand this? I want to increase my sales with 30%, but then I have to make more production. Make sense?
Okay. Yes, yes,
Okay.
Professor.
That's going to drive my cost as well with the same percent. So this one
Okay.
time 0.3, and this one will be equal to this one times 0.3. Okay. So where will be the contribution margin now? Let's get this one minus this one minus that one. And that will be equal to
Professor,
contribution
yeah,
minus, just a second. Yes, tell me.
I have a question on the fixed cost. How did it get to 4,000? 4,000?
Well, it says in the question here, if the product B is dropped, the fixed cost of 2,000 will be avoided. Where is my cost right now?
The fixed cost was previously 1,300 after dropping the product B.
Sorry? Say that again?
The fixed cost was 1,300 after dropping the product B. Do you understand?
Okay. So, Mackenzie manufactures sells the two items, A and B. The company considering dropping product B. So we drop the product B, right? Gone.
Yeah.
Now, what's going to happen now? If the product B is dropped, the fixed cost of 2,000 will be avoided. How much is the fixed cost right
Total
now?
cost is 6,000,
So if we drop it, it's going to be
4,000.
4,000.
Okay, okay, yeah.
Makes sense?
Yeah.
Okay. So right now, is that correct? So let me see. 7. Okay. So what will be my operating income if I do this?
$3,150.
Where am I right now?
$4,300.
So what's going to happen?
A decrease.
Decrease how much?
4,300 minus 3,150.
So let's see what we saving. So first, let's see on the contribution margin, right? We have to see how are we losing or are we gaining? Contribution margin current contribution margin minus the previous contribution margin. We're losing 3,150 on the contribution margin. Are we saving? We're definitely saving. How much we saving though? 2,000.
1,000, okay.
So where we are?
3,150 minus.
Minus 1,000, minus 1,150.
We're losing 1,150. So shall we go?
No,
No.
No.
Why? Because we decrease our income with 1,150. Make sense?
yes, Professor.
So the
Okay.
3,000. Watch this. The other way you can easily see it. How much is the new contribution margin added?
1,001.
Well, 1,650, right?
1,650, yeah.
That will be the how much we're adding. But I'm losing $4,800. Make sense?
Yes,
Yes,
Professor.
I'm saving 2,000, right? I'm losing
Yeah.
I'm losing 4,800 gone. Correct? That's the contribution margin loss once I get rid of product B. I'm saving 2,000. Correct? 2,000 I'm saving it. And I'm getting additional 1,160. 1,650. Correct? Where am I? Same calculation.
Minus 1,150.
Make sense? That's another way you
Yeah.
can see it. Because this one is gone. Let me see if I can find it. No, I cannot scratch it here. This one is gone. This one is coming in. And 2000 here are gone. So that's my saving. That's my loss contribution margin. That's additional gain from the 30% increase. That's product B contribution margin. That's a fixed cost saving. That's the 30% increase in sales. Make sense? And I'm losing $1,150. So my income is going to decrease with 1,150. Did I confuse you with this last calculation?
No, it's more preferable.
Okay. So the answer will be, let's go back to the question, see what's the answer. The answer in this case will be decrease in 150. Loss contribution margin 480. Increase of 1,650. Saving on the fixed cost 2,000. We're losing $1,150. Can you guys see it?
Mm.
Now, allocate limited resources. So that's another interesting thing. So what we're going to do when we have a limited resources? Let's say that the floor space for rental firm or raw material, direct labor, or anything, that may be limited. Management, you have to decide which product to make and which product to sell to maximize the net income. With the limited resources, that will be for the product that maximize the contribution margin per unit within the limited resource. Decision criteria is we to select the product or combination of the product that maximizing again the net income. So we're going to have this. We're going to produce two different phone cases, standard and deluxe. Standard, limited resources, we have only 3,600 machine hours per month. That's it. Contribution margin, we can see it, $8 and $6. Now the machine hours required per unit is 0.4 and 0.2. Can you guys see it?
Yes, Professor.
So now the question is, which product gives us the highest contribution margin within the limited resource? What's our limited resource?
Machine hours.
Machine hours. So what we had to find out, which product gives us the highest contribution margin per machine hours. Make sense?
Yes, Professor.
So what we're going to use, we're going to use the Excel spreadsheet. Let's go and use this Excel spreadsheet. I already have it for you already over here. So contribution margin per unit is $8 for the deluxe and $6 for the standard. We need 4 machine hours per 1 unit for the deluxe and 2 machine hours, 0.2 machine hours for the standard, which have the highest contribution margin per machine hours. How much will be here machine hours contribution margin?
0.4 times 8.
Sorry?
1.6.
0.4 times 8.
0.4 times 8.
Yes.
Are
I
you
think.
sure?
Not sure, I'm just guessing.
I can see that.
7.6.
Sorry?
7.6.
7.6?
Yes.
No, but that's if it's 0.4. Why are you going with the 0.4?
contribution per machine hour. Okay.
Machine hours required per month, machine hours required per month.
What we chasing? What will be the dimension of our calculation? We need dollar. So listen this. We need dollar per machine hours, correct?
Yes.
Dollar per machine hours. Which one is our numerator? Which one is our denominator? It's right here.
$8.
Over 6.04.
So contribution margin is numerator, machine hours is denominator. So how much we generate in here?
20 dollars.
How much we generate in here?
$30.
$30. Which one have the highest contribution margin now?
$30.
$8.
Standard case, right?
Yes.
So what we have to do, we have to focus our production first on the standard case. And once we reach the demand for the standard case, we're gonna start producing deluxe cases. Let's move to the slides. So what we're gonna do, we're gonna determine the contribution margin per unit of the limited resource. And we're gonna find out that the standard has the highest contribution margin. Short-term decision, focus on the product which is have the greatest contribution margin. Long-term, now we can consider to reduce or eliminate. Example will be the change of the contribution margin per unit of the limited, so remove the limitation of the resources, find another machine or anything, so we can increase that one. So increase machine capacity from, if we increase the machine capacity from 3,600 to 4,200 hours, so the decision rule here will be the same as focus on the standard cases. Why? Because the standard cases, again, they're providing the highest contribution margin. So the incremental analysis in theory of the constraints approach is to use to identify and manage the constraints to help to achieve the goal and also to require identification of constraints. Let's do this question, and I believe that we are pretty much done with this chapter.
Three.
Sorry?
Three.
B
Highest contribution margin per unit.
per unit.
Highest contribution margin per unit of limited
Okay,
resource.
which one here is the highest contribution margin? Deluxe per unit. Deluxe or
The
standard?
answer is C.
Okay, see.
C. The highest contribution
Okay,
per unit.
okay, you
C.
give
I'm
up very
leaving
easy.
it.
Exactly. Highest contribution margin per limited resource. When we
Yes.
have a limited resource, highest contribution margin per that limited resource. That's
Yes,
the right answer,
Professor.
right?
Yes.
So let's see this. Now we're producing various goods and has a limited number of machine hours available. The following data is sales price per unit 960, variable cost 620. Machine time per unit is 4 hours. Management is decided whether to limit the production of product or focus on other product. Which of the following amount should be management focus on making that decision? Sales price per unit is 960, correct? Variable cost per unit was 620. How much is the contribution margin?
It should be like 3 point.
3.40.
3.40. So
Yes, Professor.
Yeah.
here, which contribution margin we chasing here? The contribution margin per unit
per unit.
or
of
margin
unit.
per limited resource?
Margin per limited resource
So what we get to 340 is contribution margin per unit.
units. Yes, Professor.
So let's go with the contribution margin per hour. Because they have limited number of machine hours. 0.85
85.
should be the right number, right? 620 is the sales price, the variable cost. We don't care about the variable cost. 340 is, we already figured out, that's our contribution margin. 240, I don't know what is that. And 0.85 is the contribution margin per machine hours available. And since that's our limited resource, that way we should focus on. Make sense?
Yes, Professor.
Okay, we're done with these slides. Now let's move to your assignment questions, correct?
Yes, Professor.
Professor.
Let me find your assignment. Since I have pretty much most of the people now here, let me take that screenshot of how many people I have. Just in case, because some of you kind of adding, filling the discussion, some of you don't. I just want to make sure that I have that information as well.
Oh, what are the pointers? Hello, Professor.
Hello.
Is it okay if we discuss about the quiz first before the Wiley assignment?
The
Just
quiz.
the
The quiz. Yes, we can. Yeah, we can discuss the quiz
just the
first.
pointers.
Yeah.
Thank you.
Tell me about the quiz. What do you want? What do you want we discuss about the quiz? Oh yes, the point. The quiz. The quiz will be 10 questions. You're gonna have 10 questions this time. So 4 questions more. Since it's the second quiz. So you already know what to expect from the quiz. I'm gonna post here the questions from the quiz as well. So the quiz gonna start probably at 9 o'clock. Give a chance all of you to be in the classroom rather than not be in the classroom. There was one student asked me question on from the quiz questions that I posted on the very last question. Let me see here. Let me see the question. And I'm gonna copy it and put it in the Excel spreadsheet so we can all of us see the question. Okay, got the question. Let me make it bigger and I'm gonna share my screen so you can see it. This is the question that one of you asked me in the classroom. So the code Canary cells. Now what we need cells, we need the variable cost, contribution margin, fixed cost, And the question asking for the break-even point. So the break-even point in dollars. If we the break-even point in dollars, we need the percentage, right? We need the ratios. So let's see where we'll be on this question. What we can extract. Our sales as 500,000. Variable costs 425. 1, 2, 3. Fixed costs are 25. Company has sales of a variable cost. New old Canadian company have this. New world company has sales this much variable cost, that much fixed cost, that much, 250. Old Canadian break-even point in dollar is, so we're chasing only the first one, not the second one, correct?
Yes, Professor.
So how are we gonna get this?
Sales minus variable cost.
Okay, let me format these cells to put the numbers, put the decimals, get rid of those. So that's what we're gonna have, right? Again, since we chasing total sales on the break-even point, I need the ratios. Make sense?
Okay.
Sales are 100%, correct?
Mm-hmm.
Always, always 100%. How much is my variable cost as a percentage of sales?
50%,
85%.
85%,
How much my contribution margin now as a percentage of
15%.
15%,
15%,
right? So that will be equal to this one divided by that one, 15%. So how am I gonna get the total dollar in sales? Sales will be equal to fixed cost divided by contribution margin ratio. So the sales at the break even, it will be equal to what? We already know the fixed cost, 25 divided by 15, that will be my sales. Make sense?
Yeah.
I don't want you to have problem with this formulas and this calculation. It's very straightforward. On the break even, you need the fixed cost, and the sales you need contribution margin percentage. On the break even in number of units, you need the contribution margin per unit. Since we don't know how many units they produce in here, it will be very hard for us to guess what's the current sales, what are the current sales units to come up with the sales price per unit. Right? Okay, so that was the question. Again, for the quiz, prepare yourself. You're gonna have 10 questions. Okay.
So are we going to write today what the questions you given to us on the paper? We are going
On
to
the
write
paper.
it in.
Yes. The quiz will be on the paper. That's exactly the same way that was in the first quiz. In the classroom, you're gonna sit down on your chair, desk, or desk chair. I don't know how to define the chairs that you're sitting, and you're gonna do it by yourself. Again, it will be 3 covers, so know who's doing which cover. You also will know that.
Professor, and up to what type chapters will be included in this quiz?
All the questions, so whatever questions you see on this document that I posted, that will be the question. That's from where the question is gonna come. Whatever questions you see here, that's what you're gonna see. So you're gonna see questions from the cost volume profit analysis. You're gonna see from the pretty much all the chapters up to today. Let me see if I including any questions from here.
So where can we find the document?
Sorry,
Where can we find the document?
can some of you tell the gentleman where he can find the document, please? Where is the document? Can you guys see the document?
Yes, we can see the document.
Let me see. I can post also. I'm gonna post it right now. I'm posting it also under learning materials on this for this week. It's already posted for the learning material last week. Now I'm posting it under the learning materials for this week, so you're gonna have everything available.
It's on the week 6. Week 6.
Week 6. Now it's in week 7 as well.
So
There we go. Now you have it in week 7 as well. Check the week 7 learning materials and you're gonna see the questions there. Now let's go to assignment. Assignment 7.
Professor had a problem in the assignment 6.
Assignment 6 later.
Okay, sir.
If you have that problem later. So assignment 7, you have the one multiple choice question. Multiple choice question here. Then you have another multiple choice question. And another multiple choice question. And now we're going to go with the other questions. Special orders. Let's go with the question about the special orders. First question that you're going to face is question with a special order, correct? Are you guys with me?
Okay, yes, Professor.
Okay, I got this question. Let me fix it, make it bigger, and let's go share my screen. Can you guys see my screen?
Yes, Professor.
So what we're doing right now, we're selling it. Sales price is, let's make those one bigger. Sales price of this unit is $49, correct? Per unit cost that the direct material is $15. Direct labor is $10. Overhead, manufacturer overhead, $16, correct? But we have variable manufacturing overhead and fixed manufacturing overhead. Can you see this? So variable is 16 times 0.75, $12. Fixed is 16 times 0.75. Oops, not 75, 25. So my manufacturer overhead is $16 in total, correct? That's where I am. Has sufficient capacity to accept special order for 40,000 units. So I have 40,000 units. Somebody come and say, hey, can you make a 40,000 units for me? But at the discount of 25% of the regular price. So he wants me to sell those one. How many per unit?
25% to
So he wants 25 or
yeah.
49 times 0.75%. 36.75. Selling cost associated with the order would be selling cost. Direct material, direct labor, has sufficient capacity. Selling cost associated with the order would be $4 per unit. So I'm going to have my direct material, correct? I'm going to have direct labor. I'm going to have variable manufacturing overhead. Should I consider fixed manufacturing overhead on the special order?
No, Professor.
No. Should I consider the selling cost?
Yes.
Yes.
Selling. So direct material is 15. Direct labor 10. Manufacturing overhead 12. Selling cost 4. Where are my costs? $41. So how much my contribution margin here?
Where is the 4 coming from?
Sorry,
Where is 4 coming from?
here, selling cost.
Associated with
Okay. Okay.
Can you, selling cost says $4 per unit,
Okay. Thank you.
right? So where is my contribution margin? 36.75 minus 41,
Minus 425.
425. What should I do?
You shouldn't take it.
Don't take it. What's going to happen if I take it?
Make loss of
This one time, that one.
2,000.
Oops, $170,000. Oh my God, that's a lot, isn't it?
Yes, Professor.
Okay, so forget about this order. Sounds like a good deal, but no thank you. Let's move to the next question. Again, special order. We're dealing with the special orders again. Let me paste this question here. This company, product 48 per unit, cost per unit 7. Okay, this is the question. Can you guys see it?
yes,
Now,
Professor.
sales product P at selling price, so we can copy this one, right? I don't have to start over again. So here is 48. We have direct material 17. We have direct labor 12. 16 times 0.75 variable. 16 times 0.25, that much. So this company has no excess capacity to accept the special order for 35,700. They have no excess. Selling costs associated with the order indicate the net income loss would realize by accepting this special order. So what's going to happen now? I have no excess capacity.
So that means fixed cost has to be considered.
Is it only fixed cost?
No, Professor.
All costs have to be.
All costs, including the fixed cost.
So watch this.
Okay.
This one is tricky. We never talk about this when they don't have excess capacity. So
Okay.
they wanted we to sell it as 25% discount, right?
Okay.
25% discount, that's $36, correct?
Yes, Professor.
The cost structure is here, same. I have, no, direct material is 17 here. Direct labor is 12. Overhead, 12, 12, 12, 45. So it's gonna cost me $45, correct?
Yes, Professor.
Right. Now, one thing that I want you to understand now, here I have a selling cost, correct? How much is my contribution margin at this point? My variable cost here is $41, right? Before the selling price,
Yes, Professor.
right?
Yes, Professor.
So in my regular business, right? In my regular business, my regular contribution margin is how much?
$7.
Sales price is 48. Variable cost
41.
is
41.
equal to this one plus this one plus that one, right? 41. So my contribution margin in my normal business is
7.
this one minus that one. Make sense?
Yes, Professor.
Now, once I don't have a sufficient capacity, I'm selling my regular orders. I'm selling at 48. My variable cost is 41. So my contribution margin is $7. So I don't have capacity. Make sense?
Yes, Professor.
So what do I have to do? I have to stop my regular sales. Do you understand this logic? Now I have to stop my regular sales and sell it to this guy for this cost structure, right? Under this cost structure, how much is my contribution margin here? Sales is 36. My variable cost
It's 41.
is still 41, right? It's
Yes.
41.
Yes.
So I'm here, I'm losing how much? I'm losing contribution margin.
$12.
36 minus 41. Right? I'm
Okay.
losing $5 of these guys.
Mhm.
I'm already losing $5. So he wants me to stop my regular sales, which I'm making $7, and flip it to him, and I'm losing $5. So how much I'm gonna lose if I stop my regular sales from which I'm making $7?
Still lose fixed costs.
No, not the fixed cost. Fixed cost is covered,
Okay.
right?
You guys
So
second.
I'm gonna lose this contribution margin. Make sense?
Yes, thank
Because
you.
Yes,
now
Professor.
I'm selling it now to him. So for that reason, I have to include my contribution margin loss also in my calculation of the cost,
$7. Wow.
right?
Yes,
Yes,
Professor.
yes, Professor.
So in that case, my loss will be even more worse than the previous one. Make sense?
Mhm.
So
Yes, Professor.
once you listen this is the major kind of rule. If you don't have excess capacity, you
No.
have to add the contribution margin loss that you're stopping the regular sales and give it to this guy. That will be your opportunity cost. Make sense?
Mhm.
Okay, that's the challenge with this question that you may see on the assignment. Let's move to the next one.
Bro, please, the 4 in this, how was it gotten?
Sorry?
The fixed manufacturing overhead, how is it 4?
The question.
The fixed cost? Because it's 25% of the $16,
Okay.
right?
Yeah.
So let's go to the next one. With those questions might take a little bit longer, but if you're patient, and I can cover everything. Supplier. Can you guys see my screen?
Yeah.
Let me see what exactly you see. Okay, so this is the next question here. So with this company incurred unit cost of 710, 510 variable, $2, making a sub assembly part for the finished product. Supplier offers to make 14,600 of a part for $5.50. If the offer is accepted, we'll sell we'll save on all the variable costs and $1 on the fixed cost. We have to prepare the cost saving on the by the parts. Let me see what exactly they're looking for. So what you have to do is you have to get the number of units. Now let me stop saving here, and let me try to find something which is here. Okay, they expect to see from you something like this. I'm done with the Excel spreadsheet. Let me share it. Can you guys see it? Can you guys see it?
Yes,
Hello?
Professor.
Yes, sir.
Okay, that's pretty much what they expect to see from you. Now, what do you have to do? Variable cost is the first. Your number of units that we're selling, that to make is 14,600 as the number of units. Now, the manufacturing cost, we have the variable cost as 7.10, correct? No, that will be, no, variable cost is 5.10. Right?
It's good.
Fixed cost, let's make it this one bigger. Fixed cost is $2.
Yes.
So if we have to make it, it's gonna be not number of units. Let's put the number of units here. That will be 14,600. So the variable cost will be that much. Fixed cost will be that much, correct? That's if we make it.
Yes.
Now, if we buy it, the purchase price is $5.50, right? If we buy it, it's gonna cost us 80,300. Plus, we still have to pay for the $1 fixed cost, correct?
Mm-hmm.
And that will be this one time $1. Correct?
Yes, Professor.
So what's going to happen in this case?
We'll buy it.
If we make it, that will be the cost. That will be the other cost that's going to stay, but it's going to cost us only 10,000. So that will be our saving. So should I make it or should I buy it? Answer is right in front of you. Make sense?
Okay. Should buy it.
You should buy it, absolutely. Yeah,
Yeah.
totally, no questions about it. Let me get the other question. Okay. Almost there on the next question. Just give me a second. Okay, ready? Let's go. So this company makes unfinished bookcase that sells $59. Production costs are 38 variable, 10 fixed. Because he has unused capacity, consider finishing the bookcase and selling it for 71. Variable finishing cost is expected to be $9 per unit, no increase in the fixed cost. Now we have to prepare analysis. This is what they expect, Wiley expect to see from you. So what do you have to do? Sales price per unit. How much is our sales price per unit? In the first case, 59, right?
59.
How much is the variable cost per unit? 38.
88.
Fixed cost per unit,
$10.
$10. Now we have total unit cost will be this one plus that one, $48. Net income per unit will be
59 minus 40.
59 minus 48, yes, $11. That if we sell it. Let's process it further. If we process it further, what will be the selling price?
$71.
$71. What will be the variable cost? 38 plus
Mm.
9, correct?
Yes, Professor.
Plus 9.
47.
How much will be the fixed cost?
0.
47.
7, 10, same.
No, they say no increase in the fixed cost,
Yeah,
Professor.
no increase, so it's gonna stay the same,
Gonna say the same.
Okay.
right? This
Mhm.
one is expected to increase. This one, no increase,
Okay.
right?
Okay,
So the total cost will be 57. How much will be the net income per unit?
71 minus 57.
$14, right?
Mm.
So in this case, oh, I have to flip those one in order this to work. Let's flip it here. So where I'm gonna be? My increase in sales price is $12. What's happened here? No, no, that's B, sorry, wrong cell. Make sense? My
Yes.
increase in sales price is $12. My
Mhm.
increase in the variable cost is $9. My total increase in cost is $9. My net income per unit is $3.
$3.
What should I do?
You should
Process,
assess it.
process or no?
Process.
Process it. Yes.
You're making
Let-
$3 per 1 minute.
Yes, exactly. Get those $3. If somebody give it to you, get it. Don't leave it on the table. Let's go with the next one. Let me find the next one. And I'm gonna get with you right away. Just give me a second. Okay, ready with the question? Okay, let's share the screen. So this is the next question. This company has a factory machine with a book value of $154,000 and remaining useful life 5 years. This is what they expect to see from you. We're going to have this expected life, 5 years. The new machine is available of cost of $255. So the cost of the new machine is $255,123, correct?
Yes, Professor.
The machine will have 5 years useful life, matching the old machine, with no salvage value. The new machine will lower the annual variable cost from 590 from 598 to 496. Should I consider the cost of the old machine?
No, Professor.
No, that's a
No.
sunk cost. Forget about it. Cost of the new machine, yes. What else we have to consider? The cost,
Salvage value.
the salvage value, but there's zero, right? Zero salvage value.
Zero salvage value for the new
So there's
equipment.
nothing, right?
We have to
Yeah.
we have
Yeah.
to consider the variable
Right. So now we have to consider the variable cost. If we keep the old machine, the cost will be that much per year, correct? The cost will be 595, 500 times 5 years. That will be the total cost. If we go with the other machine, our cost will be 496,123 times 5 years. So what's going to happen now? If we do this, our net income is going to increase with that much. Why? Because the variable cost saving here is that difference, correct?
Yes, 197.
But we have to spend money on the new machine.
Yes, Professor.
So what's going to happen now? If we get here the totals, a second, let me grab this one. So in total, are we gonna lose or are we gonna save?
We're going to save,
We're gonna save. So shall we replace it or keep the old one?
replace it.
Replace it.
Replace it.
Replace it.
Okay, and let's check the last question and I'll let you go. Sorry, it took me so long,
No, it's fine, Professor.
but I hope it's helpful for you.
Very helpful.
Yes, Professor.
Yes, Professor.
Let's get the last one. Okay, ready to go. Let's go to Zoom, share my screen. So this company manufactures golf clubs in 3 models. has the net loss of for the year. The penny has penny line has net loss of $6,200 from the sales. From sales 225, right? The sales, they're expecting to see something else, something like this. So if they continue, you have to get to this loss. 225, 123 is the sales. Variable cost is 202,500. Fixed cost is 28,700. And are we losing 6,200? Seems like it, right? So we're losing money, right? Now, if this company eliminate 15,100 of the cost will stay. Make sense?
Yes, Professor.
So, if we eliminate it, what's going to happen with the sales? Gone. Correct?
Mm.
If we eliminate it, sales are gone.
Yes, 0.
That will be 0. Variable cost, 0. Contribution margin, 0. Fixed cost, how much will be the fixed cost if we eliminate it?
15,000.
15,100. So, if I decide to eliminate it, what's going to happen? From losing 6,200, what am I going to lose now?
8,900.
So should I go for it?
No.
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 You're losing less with it rather than without it. Make sense?
Yes, Professor.
That's was for you today.
Thank you, Professor.